President Biden has made it very clear that tax increases are coming. And even though everybody in Washington keeps telling us, oh, don't worry about it, we're only going to tax the ultra-rich. If you listen to some of the things they're talking about doing, every single person involved in real estate investing could be impacted. Yes, even if you only own one rental property. The one thing you should be concerned about most is their focus on getting more tax revenue from capital gains. And if you stick around for this video, I'll show you not only why you should be concerned about this, but also some things you might consider doing to prepare for it. Quick disclaimer. Everything I'm about to tell you in this video is publicly available information and true to the best of my knowledge. But I highly recommend you consult your tax advisor to verify. Now, one of the most attractive tax advantages of real estate investing is the depreciation. Even though the value of the property is going up, you can depreciate it and offset your taxable income. Most times, a property is depreciated over 27 and a half years, or 3.63% of its value each year. But what happens if you own it for 20 years and then decide to sell it? Well, there's this thing called recapture depreciation. Will tax you not only on the capital gains, but go back and tax you on all that depreciation you've written off for the last 20 years. Now, you can avoid this with a 1031 exchange. That's when you use the money from the sale of one commercial property to buy another commercial property. Now, the taxes are not eliminated, they're just deferred. Now, the way it currently works is that if you defer those taxes all the way up to the date of your death, your heirs will inherit a new cost basis. It's called the step-up value, where their cost basis is the value of the property at the time they inherit it, not when you bought it. Now, one of the proposed changes that they're talking about is to eliminate this, so that your heirs would inherit your cost basis and all applicable taxes associated with it. They even want to use this same method for inherited businesses. And get this, tax you when you inherit it, not when you sell it. Now, the first thing to realize is that right now, all they're doing is talking about it. But just the fact that it's being discussed should be a huge concern. Remember that the Secure Act, which completely undid a lot of strategies for long-term estate planning, didn't happen in a single session of Congress. They had been kicking around ideas on how to get more tax revenue out of IRAs for years. Now, the second thing to remember is that even though they're talking about exemptions, in the case of a rental property that you've held for a while, especially if you've gone through a couple of 1031 exchanges, you can get to a pretty big number in capital gains fairly quickly. Not to mention that it would be an accounting nightmare to go back several decades to try to figure out what that original cost basis was. Now, the good news is you don't have to do anything until they actually come out with the new rules. But I have 3 suggestions for you to consider that might make sense no matter what they may or may not change. Number 1, the fundamental concept of capital gains is you do not incur the tax until you sell the asset. So no matter what the new rules may look like, it might make sense to hold on to the asset a little bit longer than you had been planning. A new administration could change or repeal the entire thing, and that could be as soon as 4 years from now. Number 2 is you might want to reevaluate how you're holding your properties. Now, I know that a lot of us are familiar with LLCs, but LLCs are pass-through entities, so that taxable income is eventually going to be subject to individual tax rules and rates. The ideal would be to hold your properties in some type of entity that wouldn't require an inheritance to change ownership. That way, no matter what new rules they may throw out there for inherited capital gains, it wouldn't affect you. One example would be a C Corp, where you transfer ownership of the shares in the corporation and not the assets themselves. Of course, you need to balance that with the corporate tax rate, and yes, there still would be capital gains, but potentially that would be easier to manage than multiple properties purchased at different times. The third suggestion is to take a look at the advantages of owning real estate in your IRA, particularly a Roth IRA. IRAs are going to provide the maximum protection from capital gains. The trade-off is you're going to lose that depreciation. But if you debt leverage the property, you would be able to use the depreciation in the same percentage of the value of the property that's been financed. Well, I hope this is helpful. You know, I get emails, texts, and phone calls almost every day from people who are thinking about buying or selling real estate here in the Austin area, and I would love to help you out too. If you like my videos, be sure to subscribe to the channel and click that notification bell. All of my contact information is in the video description, so don't be shy. Let's make your real estate dreams come true.